So welcome everybody. This is Managing Your Bank Through Crisis, a panel discussion presented by Community Capital Technology. So we'll be discussing the SBA PPP program and its impact on community banks. We're going to be going over real life examples of managing your balance sheet risk and providing actionable intelligence to community banks as they manage through the crisis. Before we get to our group, we'd like to start by thanking the COO of Community Capital Technology, Rulana Nelson, for putting us together today. Her tireless excitement, energy, and commitment has brought us all together. I'm John Marinelli. I'll be tasked with moderating and facilitating today's program. I spent 20 years at large financial institutions, primarily in credit risk functions. I recently got into fintech and haven't looked back. We have an incredibly deep panel today. Whether you're a community leader, a small business owner, or financially curious, we expect that you'll come away with context and insight on how banks are managing through this complex crisis. So with no further ado, let's hop in and meet our panelists. We have Garrett Smith, a fintech entrepreneur who early on realized the linkage between small businesses and community banks. Garrett has worked tirelessly to provide innovative solutions and products to small community banks throughout the country. Garrett, would you say hi?
Good afternoon, everyone. Thanks for joining us.
So we have Ethan Heisler. Ethan is the Senior Director at Kroll Bond Rating Agency. He's had a variety of different roles and is in direct contact with bank, treasury, and trading professionals through his monthly newsletter, the Bank Treasury Newsletter. Say hi, Ethan.
Hi, guys. Hello, everyone.
Camden Fine, a native Missourian and a career community banker before being called to Washington to head the ICBA. Cam is going to provide a unique look behind the scenes at how bankers are working with lawmakers to shape policy during this pandemic.
Hey, everyone. Good to be with you.
And as our anchor, we have an actual banker. We have Ed Francis, a long history of executive leadership positions in banking. He's the chairman of the board, the president, and the CEO of InBanking Colorado. Ed is going to give us real insight and examples of how his organization is navigating through the PPP program right now. So we're going to get started and we're going to go to our first question. And Ethan, this question's for you. What I want you to do is to set some of the stage and provide some context to what community banking was like in the fintech arena prior to the crisis. So prior to March, as banks were starting their fiscal year, what were they looking at?
Well, as banks were starting their fiscal year, remember that the Fed had just cut rates 3 times through October. So remember, community banks are essentially spread margin lenders. That's how they generate. A bank that's say under $1 billion generates at least 75% or more of its net revenues just from net interest income. So they were already looking and facing the prospect of some of margin compression and earnings pressure. You were also in an environment where fintech investment on a variety of fronts, including CECL, the current expected credit loss, and including a variety of other requirements that regulators were having from a cyber risk perspective. These were all investments that they were trying to make. As that said, credit quality was as good as it was ever going to be.
Yeah.
So you went from an environment before the crisis that was, where you were looking out for 2020 as being a no recession on the horizon. It was pretty good.
Now, Garrett, what were your conversations with community bankers like at that time? Was it relatively optimistic, or what are some of the conversations that you had?
Yeah, I think it was very optimistic. I think the economy was obviously soaring, the market was soaring, loan demand was very strong, travel, hospitality wasn't a concern at that time, and so I think really what we saw most in terms of activity on our platform was really people showing concentration risk in certain categories or with certain borrowers that they were looking for partnerships on. So I think, the view was very optimistic heading into the new year.
And Ed, if you wouldn't mind, if you can remember, would you give us maybe a little insight into what your yearly planning was like, maybe, as you started to, November, October plan for 2020, which seems like eons ago. What was that like for your organization?
We were all focused on building core deposits. Liquidity was really tight, trying to get liquidity to the bank through new relationships. That was a primary focus. We've been talking strategically about fintech partnerships and ways that we can partner and drive a more efficient process and a more customer-friendly process at that point in time. As Ethan said, the rate environment changed dramatically on us, and like many community banks, we found ourselves in an asset-sensitive position in a situation where we had to really go to work quickly and adjust the balance sheet and make some moves to get ready for a much lower interest rate environment and a longer, maybe more extended lower interest rate environment, which is obviously very hard to manage when you're a spread margin institution.
Okay, excellent, excellent. So now the next question is going to go to Cam. So now it's mid-March, we're in a full-blown pandemic. We're introduced to all of these new programs. There are rule changes that are in the front of the paper, but there's also a lot going on behind the scenes. Cam, can you give us some of the insight in what's going on in Washington behind the scenes?
Sure. If it was mid-March, the Congress was just preparing to take its what they call spring break for a couple of weeks. The pandemic was beginning to take hold, and the first couple of packages, what I would call relief packages, were very modest. The first one was $3.8 billion, which seems like chicken feed now. And the second one was only about $9 billion. And then, of course, the big kahuna, the $2 trillion package, was put on the table just as the Congress had left to go on spring break. Now, nobody anticipated that Congress would actually be gone for weeks and weeks and weeks. They're still not back. The Senate may come back next week. The House was going to come back, but now they've decided not to come back. So you have the Senate passing bills that the House has so far agreed to, but I think that will get harder and harder. Behind the scenes, there was a great deal of struggle. I mean, it was like a lobbyist shark fest. It was like a food fight going on behind the scenes because every single economic sector of the country has been impacted by this pandemic. As a result, every lobbying shop in Washington had a dog in this fight, and they were trying to get everything they could for the members that they represented, whatever economic sector you're talking about, small business, financial, manufacturing, textile, you name it, they were all in there trying to get something for their members. And to a large extent, the lobbying efforts were fairly successful, but then it began to break down into some partisan politics, and each successive bill has been more difficult to pass, to where the next one, I think, will take probably a month or more to work through.
Now, everyone is moving so fast. What are we sort of not seeing that sort of, what are some of the risks as folks push to just get policy on the books so quickly? What are some of the risks associated with that activity?
Are you asking me?
Yes.
Well, obviously, the Congress and the government is spending money at a rate that we have not seen since the early days of World War II. And so when all of this is over, somebody has to pay for all of this. And everything is being pushed down the road. So policy decisions are being made right now to put out the fire, so to speak. But at some point,
the American people, together with the government, are going to have to rebuild. They're going to have to pay for everything that's going on now. It's a hackneyed term, but there really is no free lunch. So you can shift debt to other sectors. You can shift debt. You can move debt around, but at some point, somebody has to pay. And that will be the policy challenges after this is over.
Absolutely. So like with prior crises,
Don, can I just jump in for 1 second? So it's interesting when you look at the Fed's balance sheet to date, that it's only grown with respect to the Fed's purchases of Treasury securities and agencies. The amount, I mean, I was just talking to somebody else about this. It's interesting. The Fed announced that they welcomed any bank to come to the discount window, and they offered loans for 25 basis points for up to 90 days. Only $43 billion of such loans have been made since the Fed opened for business. And if you look at like the other programs, a lot of them have not come online yet. The Fed is not actually bought corporate bonds yet. It's announced that it's going to do that, but it hasn't actually done that. So the amount of actual balance sheet expansion is still something that it's kind of a work in progress. I agree with Cam though. I mean, there's definitely concerns out there of how far can the Fed actually grow its balance sheet. But you know, if you scratch any, and I don't do anything for ratings, but if you scratch any sovereign analyst today, they will stand by their AAA ratings for the US even after the Fed pledged to go QE infinity. So it's an interesting challenge here of what point do we actually say, wait a minute.
Excellent. Thank you so much. So Ed, we have a question for you. So one of the things that we struggle with is typically we have financial crises, and while it's not, clean, we can sort of categorize it. This one's very difficult. Do you have an apt comparison in your banking career? Have you ever experienced anything like this?
Well, I've had the good fortune, I guess I think about it that way now, John. When I was at Hancock Whitney Bank, I was the chief commercial banking officer when Katrina hit. We woke up on Monday morning with the whole bank, the IT department, the deposit ops, loan ops, executive offices, back offices, everything was wiped out. So we had to live out disaster planning, and I did learn a lot from that experience. Obviously, we were in the middle of the financial crisis, and proud to say that company didn't lose any money in one quarter during that crisis. And so there were a lot of things that I did learn. The main thing you have to do is you just have to face the facts here. The world has changed, human behavior has changed, and we're just beginning to see the credit cycle happen. We don't know what that's going to look like. It's very cloudy, but there obviously has been significant impact to not only folks who are employed, but to businesses. Some of those that will never reopen their doors. Office space, I believe, it's changed forever, given that we've proven that we can work out of our homes and be even more effective and productive than we thought we can be. So I think that the world has changed here, and we got a lot of work to do the next 12, 18 months in working through this cycle. And it's a little scary because you don't know what you're doing. The only thing to do here is to face the facts. When you deal with truth, you can really usually make good decisions. And it's just, you got to lean into it and just embrace it. I've also learned that through crises, there's always opportunities. The PPP program has provided community banks a huge opportunity to really step up and help communities, help customers. And so, I think the answer is not clear, but I think through those experiences, I've learned that you have to lean into it, try to find where the opportunities are, and face the brutal facts of what's coming at you from a credit perspective.
Yeah. Now, so you feel that experience has helped you at InBank sort of get through this, and you've been able to communicate with your senior management in sort of those respects?
Absolutely. It led us to get ready for the PPP program. As soon as the bill was signed on Friday night, we had a conference call 8 o'clock Saturday morning, getting the team ready, because we knew this was going to be an opportunity and we needed to do the right thing for our communities. It was living out, our mission and purpose in our bank. And so we went straight to work and came out of the gates ready to go. And we've had a lot of success because of that experience and my ability to communicate that to our team and get them ready for what we thought was going to be a great opportunity. And it turned out has been a great opportunity for us.
Now, it seems like community bankers are taking the lead, and I think that's one of the things that was a little bit surprising to me. Are community banks typically drilled in disaster recovery in these types of efforts?
No, I don't think disaster recovery is something anybody ever thinks is going to happen to them, right? That's not going to happen to me. We got to go through this planning, but it's never really going to happen. So I don't think that's the reason why the banks were successful. I think the reason why the community banks were successful is that we know our customers. Our value proposition is to have deep relationships with our customers and know them intimately. And I think our ability to do that has provided a value proposition that is very attractive in today's world. Unfortunately for the big banks, they have so many customers, and the way that they have built their systems to be based on efficiency and scoring gets away from the relationship. And so if you find yourself, especially if you're a deposit oriented customer, you don't borrow money regularly, find yourself in a situation where you don't know where to go. And so community banks that have raised their hands and shown leadership have gotten opportunities to help folks like that. And that's been a real win for us across the country.
Let me amplify on that just a little, John, because Ed is absolutely spot on. And I think Ed's Katrina example plays into this. The smaller banks in the Gulf region really stepped up to the plate rapidly after Katrina hit. And it fits perfectly into the community bank model, which is a relationship-based banking model. So community banks, just as a model, stay very close to their customers. They're very flexible. They provide easy access for their customers to liquidity, to credit, and so forth. And probably the biggest thing is community banks can move very rapidly because they're flat organizations. So you're not dealing with non-decision makers. You're dealing with decision makers right away. And that is a big advantage, particularly in a situation that we find ourselves in now. Community banks can move very quickly to move toward and lean into the crisis, whether that's a Katrina type crisis or in this unprecedented crisis, a pandemic like we're going through.
Yeah, and if I could just add something there, I mean, obviously the PPP is an unprecedented move, but a lot of the community banks had a good deal of prior experience working with the SBA. And maybe just to offer a comparison, I mean, you know, one of our larger clients has over 20,000 employees, and their SBA department was 30 people. So I think given that community banks had that track record and had that experience working with the SBA, I think that's also been a driver of some of the success that banks like Ed's have seen.
Yep, well said.
So now, how are Garrett, maybe this is a little bit to you, how are fintechs sort of able to assist banks that are, you know, traditionally relationship banks and focused on the, right, so not like large, efficient sort of outsourcing models, but how are they able to amplify those relationships?
Yeah, so I think, you know, our experience working with our partners has been a phased process. I think, you know, initially in early March, it was really, you know, looking at the portfolio, looking at the client relationships, understanding where everybody was at and kind of getting a sense on that. Phase 2 was really all PPP, and you might even say phase 3 now that they've just, you know, initiated the second phase of that. And I think now what we're going to see is really, you know, particularly with a bank like Ed's, it's okay, now that you've been able to acquire new customers, new deposits, your bank is now operating on a more virtual basis. How do you engage those clients and maintain that you're able to retain them? And so there's, you know, all sorts of client retention technology out there, engagement technology as well. And so I think that's where the initial focus is going to be. I think, you know, it was kind of pie in the sky thinking that, Fintechs would be able to come in and somehow magically enable the banks to process applications for PPP more rapidly. Most of the community banks that we work with have just, gotten their hands dirty and really done the work as opposed to using some sort of slick interface. But I think on the back end of this, as we start to see more portfolio valuations and more transactions taking place on the back end once PPP is done, I think that's a really good opportunity for tech companies to partner up with community banks.
Ed, if you wouldn't mind, could you give us a couple of your experiences, how you guys are using technology?
Absolutely. I think this is a really important point and something that we're having to deal with right now. So over the last month or so, we've onboarded over 300 new to bank clients. To put that in perspective, that's probably 2 years, maybe a little bit more worth of work for us. So the going back and making sure that we've onboarded those customers properly, that we've integrated, their treasury management solutions, that we've integrated any kind of operating lines or refinancing any loans, all that has to take place. But what's happening is that the market, I've never in my 2 years seen this kind of disruption. And so there's so much opportunity coming at community banks, it's really hard for us to handle because we haven't built these efficient processes. And so what we're thinking about is we need a fintech partner that can act not only from a technology standpoint, but from a middle and back office, helping us manage small business relationships. We have a unique way that we're thinking about it, that every relationship has a relationship manager that may be virtual for small business and for consumer, but it's important now that somebody knows who to call when they have a problem, right? And so we're thinking about partnerships with fintechs in a way that it's not just a technology solution, but also a solution that can help us, add some efficiency in our middle and back office, because building that out for a community bank is very expensive. And it's hard, you have to get the volumes to create the revenue to justify it. So that is something we're having discussions with right now, trying to figure out how do we solve it. And that's if there's a fintech company listening today that has a solution, we're all ears and looking for a partner in that space today.
Now, Ethan, through the rate environment and the level of consolidation we see every year from banks, is it too late for a bank to get started in fintech and get started with partnerships or buying product, or what would you advise a bank?
No, I think that this is more than ever. I mean, first of all, I think there's been so much leveraging of technology just in the last month, as Ed was talking about. We're processing stuff that would have taken you 2 years to go, that if anything, if you haven't made those investments, do it now, because the train is leaving. The ability to access your institution remotely is going to become the name of the game. And institutions that are stuck with just an older meet and greet model, face to face, and don't learn how to adapt, I think they're going to lose out. So absolutely. The only thing I would say is that technology investments are not something that you make and you're done with. Technology investments are things you're always making. And so, I think that there will be a lot of pressure going forward. You update now, what do you do 5 years from now? I've talked to some larger institutions, they've invested in trading floors. Well, okay, it is great to be on a trading floor and see people face to face, but do you really want to spend for all that infrastructure and all the technology upgrade over the next 5 years if you actually could have just shown that you can get a lot of that business done remotely? Like I said, I think there's nothing black and white in the industry. But to your question, no, I think technology is something banks are going to continuously spend on, not if they didn't spend on it, won't spend on it. Also,
Hey, John,
just one more thing before I finish. There was an interesting piece by Gary Cohn yesterday in the Financial Times talking about the move towards digitalization. So as digital payment becomes a bigger and growing trend, we might, if you haven't done those investments, that you could be in serious trouble with respect to your participation in the payment system.
Yeah, and I would add too that, the banks that were moving traders remotely, that was probably the most challenging component of this work from home period. And so if those large institutions are already talking about, how to augment their trading operations, then, I think that puts every single other thing that the bank does in play.
John, may I make a comment here? I'm
Please,
sorry.
Ed.
This is a bold statement, but I think it's very accurate in today's world. If banks are not thinking of themselves as fintech companies, the world has passed you by. I mean, we are financial technology companies. If we're going to be successful, that's the mindset we have to have. The train, as Ethan said, the train has left the station, and it's up to us to really adapt to consumer behaviors. And this pandemic has shown us that we can do things that we probably never thought possible. We always thought we needed to be together, but we've proven that we can do business and be effective and efficient by working remotely. And so, if you're not thinking that way, I think that mindset has got to change.
Now,
Yeah,
Ed, go ahead, Kim.
pardon me. I was going to say, if this pandemic changes anything, something that I think will last is there's going to be a major shift in how organizations function after we get to the other side of the pandemic. I think office culture is going to change, protocols, procedures, all of that will change. A good example is in downtown Washington, D.C., you have approximately 3,500, and that's not an exaggeration, trade group associations headquartered in downtown DC. There are of those 3,500, about 300 of them are considered very large trade group associations. ICBA is one of those. We leased 45,000 square feet just in downtown Washington, not including other locations. Now that entire office that was occupying 45,000 square feet has been working from home now for almost 2 months. Probably they'll be working from home for at least another 4 to 6 weeks, at least. So they're going to discover that they don't need 45,000 square feet. They might need 15,000 square feet. So that, I think every trade group in Washington is going to be reassessing how much office space do we actually need to function? Because in Washington, just to get in town in the morning, if you live outside the district, takes you an hour to an hour and a half in the commute. The same way in the evening. So 3 hours of your life is taken up crawling in traffic. How many people are going to be willing to do that again? And of course, then that has major implications for CRE and commercial lending. That's going to be totally changed after this pandemic. And in some cases, in a lot of cases, not in a good way for the lenders.
Right. No, I agree. Now, there are getting dressed is another behavioral thing that we might all sort of encounter as a.
I dressed up today. You see.
I have a hoodie.
So I guess, so to Ethan, who is clearly very adaptable, what are some of the other behavioral changes that we see? I mean, obviously this is going to come in waves. This is not going to be sanitary. It's going to be, all over the place as far as, what cracks first and what wave goes next. And it's going to be confusing. But what are some of the sort of waves that you've been thinking that are going to crash next as far as maybe behavioral changes or?
Well, again, to echo what Kim was saying, I think the lesson from the financial crisis was urbanization. That you were seeing more and more concentration, moving, not buying the house, but living in an apartment. Millennials didn't want to buy a house; they wanted to maybe live in a rental apartment and whatnot. I think what the new thing is suburbanization, and to echo what he said, I think we'll see big ramifications for commercial real estate down the road, which will have broad implications for community banks that lend in commercial real estate space. Mass transit, another thing that I think will change in municipalities and how they function. we're really living in the brave new world. To compare this to anything else is just impossible. Even the 1918 Spanish flu never had a society that flies around, the general public goes from New York to wherever in a blink of an eye, or stays in big conference rooms. I understand that the MGM Grand is something like 6,000 hotel rooms. In Riyadh, I heard that there's a hotel with over 10,000 rooms. I can't imagine anybody going to things like that ever again. Or if they go, not wanting to be there, not for any length of time. The way we integrate with people, like we have big conferences. You go to resorts and have these conferences, and I think a lot of that's going to change. Then again, I don't think it's all going to change. I still think that there's going to be face-to-face. There's still going to be some amount of, hey, let's grab a meal, let's do something. But that's way off. That's a couple of years, I think, before that's viable. And I just have one more thought I've been thinking about. I think we will have planes again. I think people will go to restaurants, but the ones that fly on airplanes will have to be willing to pay 2 or 3 or 4 times what they paid for before for that same plane ticket, because they've cut out all the middle seats. And I think when you go to the restaurant and you want that steak that you were paying $40 for, you might need to be ready to spend $80 for it. And I don't know how many people want to really do that. So salespeople that thrive on that, I'm going to take my customer out to a great restaurant or whatever, that whole concept, that's going to change. And maybe it's better, I don't know.
Yeah. So Ed, back to relationships. So you have all these new to bank customers. You have, this book of business. It's a little bit kludgy. Are these loans forgivable? How are you sort of dealing and prioritizing just the daily banking part of, going through your book?
Well, what we're trying to do is put ourselves in our customers' shoes and make sure we're fulfilling their needs. So the follow-up, making sure we understand those relationships. We did a lot more due diligence on our new to bank clients than just doing the PPP loan. We wanted to make sure that they were obviously good people and creditworthy and the right kind of customers. So we did a good job on that, but going back and really making sure that onboarding experience matches the value proposition that we want them to have is very important. One of the things that we're doing right now is working with our law firm to plan a web conference just like this to talk about forgiveness and allow our customers to talk to some experts and attorneys about how that's actually going to play out. So we're thinking about how we do that. We're developing welcome kits for all of our new customers with some in-bank swag and just things to do to make sure that they understand that, we're a different kind of bank and that their relationship really is truly valued here. And the fact that we know who they are. I think that's a really, really important piece today, is to make sure that every customer knows that they've got a banker to reach out to. And if there's a question or they're concerned, they know where to go. It's not call 1-800 and get somebody that doesn't know you and has to spend, 10 minutes verifying who you are. It's a relationship that, hey, this is Susie and I've got this issue and I need to get it fixed. That's a different value proposition than those customers have been used to. And I think something that is going to really resonate and allow the community banks to have a few years of prosperity before behavior goes back to whatever the new norm is. Hopefully it never goes back and people realize this, because we've been touting this for a long time, but now given the pandemic and the conditions, it's really resonating with folks about why a banker and a good bank is important.
Now, before the crisis, was services and consulting and these types of efforts, were they a part of your everyday, or is this sort of a different shift in your thinking?
No, absolutely. That is our value proposition, is to treat, we grow the bank one customer at a time, and our ability to, customize solutions and understand their business, structure loans, structure payment strategies, all those things were everything that we did. But we did that at a pace of about 5 or 6, maybe 10 a week. Doing it at a pace of, 300 in a month means that we really need to focus on, making sure that experience is what we want it to do. So not just taking that and going on to the next new customer, really circling back and doing a really good job of making those customers feel welcome and valued in our company. I think that's really important for us and for other community banks to do.
Excellent. So, why don't we get ready to wrap it up? So what are maybe, why don't we start with, so Cam, what are some of the things that you were thinking about as far as takeaways or lessons learned, or either prior lessons that we've learned throughout crises and you know, issues that we've had that we can apply here? And then where do you think, you know, previous thinking or previous history isn't going to apply?
Well, I think we've learned. I can only speak to the community banking industry because that's where I've spent my entire career. So I think those of us that were around during the savings and loan crisis learned a lot. We certainly learned a great deal during the great financial crisis. A lot of those lessons are being replayed, but we reacted better on the financial side. Remember, this was not a financial crisis this time. This was a pandemic, and actually the financial industry stepped up to the plate on this one and has performed very admirably during this particular crisis. Ed and his colleagues throughout the country in banks everywhere have just done a spectacular job reaching out and giving the public some comfort, at least financially. And I think that's a big distinction between this crisis and obviously what is termed the financial crisis of 2008 to 2011. So that is a huge difference. The financial industry is a player that is providing stability in this crisis rather than being unstable in the last crisis. Another thing that I think was learned, I think Congress learned, and more so the agencies, more so than Congress, but both the Congress and the agencies learned that you have to move very quickly. That you can't sit around and watch things unfold. You have to try to get ahead of the curve. And, you know, it is a credit to the Congress in that they've passed 3 major relief bills in essentially record time, and with one of the bodies not even meeting in Washington. And more so the agencies. The agencies reacted much more rapidly in this crisis than they did in the first one or in the savings and loan crisis. So they learned, and they have relaxed a broad range of regulations to try to get out of the way of the bankers doing their jobs. I think that they could do more, but at least they've done quite a bit. And I think they may do more as this thing continues. So yes, there's been lessons learned from the prior crises, and they've taken those to heart, and I think in a good way.
Yeah, and I'd just add to that quickly. I think, you know, relative to, and we were kind of joking about this before the call, I think I was about 4 years old during the savings and loan crisis. So I can only speak to what I've read. But I think what's been different here as well is that, you know, the banks and the government have worked hand in hand through this. And I don't think any of this would have been possible if the government tried to take it on themselves. I mean, obviously the Fed has done quite a bit on their end, but, you know, in terms of getting the money out into the market with PPP, I don't think it would have been possible without working with the banks. So it's been really nice to see that sort of collaboration taking place as well.
I would just add, I think that there's a big difference between this crisis and any previous crisis. Is that in, like, say, the bank crisis, the great financial crisis was a banking crisis.
Right.
This crisis is a capital markets crisis. So money market funds need to be bailed out. CP needs to be bailed out. Corporate bonds need to be bailed out. People are thinking equities need to be bailed out. I have no idea why equities would need to be bailed out, so that's what's changing now. I think we're going to come back from this and look and say the leverage moved out of the banking industry. It moved into the non-bank shadow bank industry. What we need now to do is to bring the shadow banks out of the shadows and into the light of regulations with the rest of the banking industry, so that we can minimize that level of disruption. There is no reason why the Fed should have to go ahead and bail out the money market industry, the CP industry, or whatever. That the banks are enough to worry about.
So Ethan, is your message that we're sort of all into this together, and that, you know, after the smoke clears and then it clears and then it clears again, we'll just have to sort of get through it together?
Yeah, I don't agree that we'll ever really pay any of this off. I think that's hopeless. The budget deficit already was too difficult for Congress over years and years and years to address and actually reduce. You've just pushed that even further out the window. We need to grow our economy, and if you start really trying to pay off debt, you're going to reduce your economy, and that's certainly not going to be a solution to anything. I think the real risk here is we've lived with this idea in the capital markets that the Federal Reserve was going to normalize its balance sheet. The hopes of a Fed normal balance sheet, I think, are very unrealistic anytime soon, and that's going to weigh on every participant, whether they're community banks looking to try to put on securities today with yields at sub 1%, or they're trying to put on, or they see loans that potentially are going to be floating rate at a SOFR rate, which is tied to a risk-free rate that traded at negative rates a couple of days earlier in the month. I think this is going to change everything.
So Ethan, before we move off you, we do have a question for you. Hans sent in a question. What kind of stress are you seeing from banks that you're following? And do you think that there are going to be an increase in bank failures due to loan losses on liquidity?
I think so. As far as stress that banks are feeling, they've reported provisioning at the end of March, which was multiples higher than where they were just a quarter before. So I think it's still early to see how far. Most banks report that this crisis, they believe, will come to about 50% of the stress environment for the DFAST. Whether that plays out or not, it's hard to say. What was your other question? What was the second part of that question, John?
Will there be an increase in bank failures due to loan losses or liquidity?
It's hard to, yes. I think inevitably when you see 30 million claims in 5 weeks, I think it's inevitable that you're going to see bank failures. How this cycle plays out compared to the last cycle is still difficult, because I never had Congress vote in $2.2 trillion worth of stimulus. And I have no idea how all of that plays into this type of recovery or what severity. Banks are sitting with, the community banks are sitting with strong levels of capital. They can weather a storm. Can they weather a lockdown? That's unlikely.
Yeah.
So we're going to see more, we're going to see casualties, no question.
Now, Ed, thoughts on this?
Yeah, I kind of agree with Ethan. It's a little early to tell, but obviously with the kind of economic impact we're having, you're going to see some casualties. I think banks are better capitalized. They've been better at taking risk. A lot of this is going to depend on how the regulators work with us and our borrowers. In past crises, they've kind of forced the rat through the snake pretty quickly so that we could recognize those losses and get through the crisis. It's going to be interesting to see. Obviously, those banks with consumer books right now are probably the first to feel impact. But the trickle down impact, office space, commercial real estate. I mean, we're going to see it. It's really hard to tell. I'm thinking about this too, Ethan. I've got 4 kids that are in college or graduating from college, and this is a debt that they're going to have to live with. This is an economic cycle that their kids, my grandkids, are going to be taught in school. This is we don't know what this outcome is going to be, and we're kind of living in history at this point in time. I've often referred to it as coronavirus Jumanji. I kind of feel like I need to get out of the movie right now. That's where I feel like we are, and we don't know While I have the floor, I do want to say one thing, John. The SBA has gotten a lot of criticism. Let me just say it that way. I had the opportunity to testify in front of the House Small Business Committee after Katrina, because typically the way SBA handles the disaster loans is that they make them directly. In that testimony, I was basically lobbying to give the banks the opportunity. We know the customers, we know where the need is, we can get the money out quicker. I think they did exactly the right thing. What the SBA has been able to do in a very short period of time, the amount of money that has gotten to the hands of businesses is incredible. So I think they deserve a big shout out for, is it perfect? Heck no, but it couldn't be perfect in the time frame that they were asked to do something. Right. What they've been able to do in the tools that they have given us to help clients in our communities, it's really something almost kind of a miracle that it's been able to go as well as it has. And so I just wanted to make sure that was said and said out loud, that they deserve some credit in this.
Yeah,
Ed, can you comment on that?
I'm glad you said that, because in 2019, in the entire year of 2019, from all sources, the SBA did 58,000 loans. They were doing that in an hour during this crisis. In 1 hour, they were pushing through tens of thousands of loans. And so I think Ed did a service there, because there's going to always be problems, but the SBA actually has performed pretty well, given that they were gobsmacked by this thing like everybody else, and they've been able to push through the number of loans that they've pushed through.
Now, Cam, do you think there's going to be a relaxation on the backside as well, as far as, KYC, AML, right? We get everybody, we get everybody into the bank, right? And now we have to sort through them. And that's for the last 10 years, that's been a focus. What are your thoughts?
I wish AML and bank secrecy would get modernized and updated and streamlined, but those are kind of sacred cows, because they deal in most policymakers' minds with terrorism and that kind of destruction. So it's very hard for a policymaker to relax those particular specific regulations, because then the next terrorist act, they're going to get blamed. And so they're very careful about those two specific regulations. However, more broadly, I think depending on what happens in the fall elections, I think that's the pivot point. That will be key. So if Trump is reelected, I believe the agency heads will take a good look at a broad range of regulations in light of this crisis, with the idea of modifying them, streamlining them, or relaxing them. However, if the Biden administration gets in, while there might be some of that, I think it would be more rifle shot. It would not be across a broad spectrum. It'd be more rifle shot kind of take a look at this particular regulation or that particular regulation, rather than a broad range. And I think that if Biden became president, his administration would be much more consumer focused than business focused. Let's put it that way, because that's just the philosophy of the two parties, and those would obviously come into play.
Ed, any wrap-up thoughts on this, sort of the KYC AML burden, and are there opportunities to, both, meet your regulatory thresholds and sort of make it easier on you guys?
Yeah, this is one of the things that we've had to pay a lot of attention to when you onboard that many new customers, making sure you do this the right way. So I think it's a law that's needed for the reasons that Cam pointed out. We could use some modernization about how we can know our customers and different tools that we can use to do that. Today's world where you can't actually meet somebody in person, we've had to adopt some new policies about how do you prove identity and those kind of things. So we've worked through that, but we have to do a good job under the current regulation Does it need modernization? Yes, but we also have to make sure that we're paying attention to it because it's a very important piece. There's some people out there that that don't always think of these things as opportunities to do good things. They think about opportunities to do bad things, and so we have to be careful on our risk management side that we're doing the proper amount of due diligence and knowing who we're bringing into the bank.
Yeah, I think that's well said. As we've been going through this, I just think of, helping small businesses and helping the community and how do bankers, do this. And you just stop thinking about things like fraud and nefarious actors, for a few moments while you're in a crisis. And I guess you can't stop doing that. I guess one thing I'd like to say to the folks that are listening or watching on the web, if you do have any more questions, please feel free to send them in. As we're sort of, moving on, what I'll do is, Garrett, I'd like to sort of throw it to you around, what you're seeing as far as loan portfolio management. If you can give us a few minutes on that.
Yeah, absolutely. I mean, I think as Ethan was kind of saying earlier, it's the way these assets are going to be valued is clearly going to change. I think particularly in the community banking segment, commercial real estate is and has been traditionally a very large portion of the balance sheet. So I don't think we're really going to see any clarity or visibility on that until probably late Q2, early Q3 of this year in terms of how those assets are going to be priced. But certainly there's going to need to be quite a bit of balance sheet optimization taking place coming out of this, especially considering some of the concentration that's resulted from PPP and whether or not, the Fed is actually going to come in and take those off the balance sheet. So I think, data and analytics, just kind of getting back to the fintech conversation, I think that's going to be a big spend for a lot of the banks right now. I think, trading activity, if you look at it from the prior crisis, actually increased post-crisis. So I think we're gonna see a lot of that as well. And I think it's just a matter of time to determine how these assets are going to get priced and who the natural buyers and sellers of them are.
Yeah. Now, Ed, how do you sort of even think to manage a portfolio like that? I mean, you have fundamental credit and then you have scenario analysis, and there's a lot of ways to look at a portfolio. I mean, do you just get into a room with your bankers and sort of throw some ideas around, or how do you start to, manage these sort of unknowns?
Yeah, we've been doing that since day one, John. And so the best way to do it is to continue to have conversations with your clients, understand what's going on, take that information and stress the loan, whether that's, in real estate or C&I, et cetera, just understanding what's causing the downturn. Obviously, those folks that have, hospitality and restaurants and those kind of things, how soon that is going to come back is a really big unknown, right? If business travel stops like we're talking about and hotel occupancy goes to 50%, there's going to be some real casualties here. So I think the only way to address it is to peel back the onion and dig in hard and know the facts. Again, when you have the facts, you can make pretty good decisions. It's making decisions with the unknowns that when it gets really difficult. And so I would just encourage, ongoing conversations, weekly conversations with your clients and checking in and seeing how things are going. And then we've got to adjust our risk ratings and, our reserves based on that information that we have and deal with the problems as they come to us.
So now if you put, say, a set of loans in deferral, you'll set up a frequency of calls and, it's almost like, is it almost like a triage situation with every sort of department where, in a hospital, you would have sort of cardiac, this, that, and the other, and, you would have CRE, on these other books?
Yeah, I'm afraid the CRE officers are going to probably turn into workout officers here in the next 24 months. That's the cycle we're in. And so, it is definitely triage. We're looking at things of, how much liquidity do they have? How much carry do they have? What kind of stress level can they take from an occupancy standpoint? All those things. And so it's, it's not a one answer. It's really a customer by customer answer.
Yeah. Ethan, any thoughts on this?
No, it's like I said before, I think banks write their portfolios for recessions, and they can write very conservatively and have very low loan to value ratios. But in in a lockdown like this, it really fundamentally changes the entire scorecard in ways that, you know, you don't really know what the weight's supposed to look like, but that smoke still needs to clear. I liken this crisis to driving along at 70 miles an hour without a seatbelt and crashing into a brick wall. And as you're crashing, you reach over and you try to click the seatbelt. That's kind of where we're at. I think so far we've done okay, but you know, you hope for the best, you prepare for the worst, and that's what you're seeing banks say to everybody. It's too early. It's going to be worse. Prepare. We're prepared. Banks look well capitalized. Hopefully, most of them survive. Prepare for surprises. I will say every crisis is always a surprise. You know, you never really thought that the resi market was going to blow up in 08. That was like an article of faith from the 91 cycle when you had the commercial real estate blowing up was you got to invest in real estate, commercial residential real estate. Nobody have defaults on their home and it's highly granular. Well, look at that. Highly granular still got into trouble. This time, it's just how did 5% of the economy drive 30 million claims in 5 weeks? I mean, if you think about it, you add it all up, air, transportation, restaurants, hotels, all that stuff. That's yet, according to the BEA, that's 5% of the whole economy. It just drove 30 million claims. So I would expect we'll see, you know, the big surprise is what you didn't see or what you didn't think is going to happen is going to happen. And that's it. I liken it to, if you think of the Jeff Goldblum character in Jurassic Park, that's my other favorite thing to tell people. So, you know, Jeff Goldblum explained why did the dinosaurs all run amok on that island? Because they had this very highly complex system. One thing went bad, it caused a cascade of other things that went wrong. That's where we're at. Hopefully not Jurassic Park, but that was what he said right before he got ate by the Tyrannosaurus Rex.
So, Ethan, you're not going to do any better for a final thought than that. So I will sort of close your window out on that. But Cam, what would you have for, you know, sort of final thoughts here?
Ditto to Ethan. I love Jurassic Park analogy because he's right on. It's always the thing you don't see coming that's going to whack you at the side of the head. You prepare for the things you see in front of you, but you can't know what you don't know. And there will be unintended consequences come out of this thing for years. And we're not even in the middle innings of this ball game. We're just in the first 3 innings of this ball game. And we don't know what the 8th and 9th inning looks like. And there will be lots of ups and downs between now and whatever we deem the end of this. It won't be just the end of the lockdown. The follow-on is going to be years. The typical deep crisis in America has typically taken somewhere between 7 and 10 years to get back to normal. But I liken this a little to the Civil War and the GDP. To give you an idea, if you take the GDP of the southern states in 1860, it took them until 1912 to get back to that GDP from 1860 because of the destruction of the Civil War. And if you liken it, that was sort of a total economic shutdown in the South because of the blockade. And they were just shut down for years. And it took them 50 years to get back to even. This is the first time in our, even more so than the 1918 pandemic, the 1918 pandemic, we actually didn't shut down the economy like we've shut down the economy because of communications, and you didn't have what we have today. We've never done this in the history of the United States before. And the closest example I could get to was the South during the American Civil War, when essentially their economy was shut down. And look how long it took them to get back to even. And those are some of my concerns.
And Cam, you can go back a little further to the Black Plague, which I don't think you were alive for, but you know, then that was even worse.
No. I do remember the tail end of the Civil War, not the Black Plague. No.
So, now, Garrett, how about yourself? What are some of the takeaways you want to leave us with?
Oh,
Garrett,
Oh, I think you're on mute,
Yeah.
Garrett.
can't hear you.
So I was just saying that I think to Cam's point, you know, I think we're early days of this. So I think everyone, what's the saying? Keep calm and carry a towel. You know, I think we're gonna be in this for quite some time, and you know, as someone who lives in New York City, we're starting to see certain things get back, and we're starting to see construction workers back on the street, and you know, we're starting to see signs of life again. And so I think, you know, heading into the summer months, hopefully everybody will be a little bit more optimistic. But I think that this is going to be a long game. So.
And final takeaway, Ed.
I don't know if I have a lot more to add, John. It's, you know, obviously we are in uncharted times. Thank goodness I don't think this is going to last as long as the Civil War did. So hopefully the impact is not as great. But coming out of this from a total shutdown is going to be very difficult. And you know, every day we gotta come in with our eyes wide open and be looking for those blind spots and being prepared. You know, making sure that we understand, you know, what could happen and what that impact could be. You know, our goal is to be strong. We think that there's going to be opportunities that come out of this. You know, I've said that before, but here, you know, being strong, having capital, having liquidity for banks is going to be very, very important. And you know, those that come out of this are going to be stronger and better. But unfortunately, it's going to be a long slug, and you know, and one that we don't look forward to. You know, us bankers that were in the last crisis, that last 10 years of just slugging it out, and you know, we were finally getting to a place where it was kind of getting fun again. Well, I think the fun days after PPP are going to be over.
Yeah.
We're just going to have to row the boat hard and make sure that we're being very prudent and just facing the facts that you know, things have changed, and we've got to change our models, and we've got to deal with any kind of credit issues that are coming at us. Somebody's going to have to pay for this, and unfortunately, you know, the banks will have to pay for it. Some of the borrowers will have to pay for it, but it's definitely going to impact the economy, and the domino effect is something that it's really hard to understand at this point in time, this early in the game anyway.
I just want to thank you guys. This was, I mean, so interesting to me, you know, spending 20 years in banking and to get to spend the time with you today. I just want to make sure that everybody listening, Community Capital will be able to provide you with a recording of the webinar. Additionally, we are going to have another webinar coming up, and it's going to be on community bank partnerships with Fintechs. So again, I want to thank our fine panel. I learned a ton, and I hope that everybody that was able to join us, you know, again, was able to sort of take something away. This was fantastic. I just want to thank you guys.
Great.
Thank you.
Thank you.
Enjoy being a
Thanks,
part of it.
everyone. Thank you, John.
Bye-bye.
Have a good day.
Take care.
Yeah. Good day, everybody.